Let's go to the markets. We have a mixed picture on this Monday. Nasdaq's the winner. No surprise, because obviously what's happening in the tech and the chip space today, more specifically. So stocks record high, Bitcoin record high, gold record high. Joe Edjardini raises his price target back to 7,000. He'll be with us on Closing Bell today, so you can hear directly from him. He says the odds of another melt-up are at 30%, up from 25. He reduced his base case for a sustainable bull market, i.e. without a correction, to 50 from 55. So in other words, he's just more bullish. He is more bullish.
He is more bullish, and we're continuing to see the rally broaden out. Most recently, you have the Russell, which has broken out from a double top that it was traced out from 2021 and 2024, so now that's participating as well. I've said the calendar is the enemy for those that are bearish, because, in fact, you are going to see portfolio managers begin to chase. We're going to talk a little bit more about what Paul Tudor Jones said on the network today, but he summarized something that I am feeling and that portfolio managers and financial advisors I speak with are feeling. And that is, at the last leg of a bull market, generally that's where you get the strongest price appreciation. So you have to be there.
The so-called blow-off top? Is that what you're referring to?
You have to participate, but you also have those happy feet. You almost feel as though you're on your front foot, ready to sprint away from the market, and have to be very tactical in doing so. And I think we all kind of collectively feel that way, but we're afraid to make that move ahead of the end of the calendar year, because what's in front of us right now is a little bit unknown in terms of price. Okay. This could extend a lot further than we think.
You're talking as if everybody knows what you're referencing. It's Paul Tudor Jones, who was on Squawk Box today, and he was asked about whether there's an AI bubble, similarities, rhymes, et cetera, to prior periods in history, especially, obviously, the late 90s. Let's listen to what he had to say, and we can kick it around on the other side.
Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
All right, that's Paul Tudor Jones. Always worth a listen anytime he is on this network. The idea is that, you're afraid to miss out, so you keep running with it, but you got to get out quick, because eventually it's going to end poorly. The challenge is being able to identify and get out quickly. Even if today it's going to end badly, you still don't want to miss out. As he references, we doubled in the NASDAQ from October 99 until everything ended in not too, late 2000.
Yeah, so you're really trying to pick that point in time when FOMO, the fear of missing out, turns into JOMO, the joy of missing out, when the market declines.
Do you think we're in the FOMO period now?
I do.
Have we really entered that yet?
Oh, I think we've been in it for a while, but here's the difference between 99. I think it's going to end the same way, but the reason why this will extend longer than that October to March period that he's referencing is that you can go into business just by hanging a sign out and taking advantage of the internet. And it really didn't take much capital to do that. Here, you actually need capital to play, and you need real engineering talent, which is human capital. So, sure, you've got some small companies in the private markets that just aren't going to have any business model ever. But when we're talking about the larger companies in the private markets, they're real assets. So what you're talking about is not sustainability of a business model, but valuation of the business model. So there'll be plenty that go bankrupt and belly up, as I said, but overall, I just don't see the bubble bursting while you still have this major spending cycle.
Well, that's the thing.
CapEx going on.
That's the thing. It's as long as the capex music is playing, so to speak, people are going to continue to dance to it. Yeah. And there's no indication at this point that it's going to stop anytime soon. And many notes are talking about the fact that, look, capex is going to remain robust, and then that's still going to be the thing that carries it. Wells Fargo today, don't underestimate the capex cycle. Expect it to continue. Eric Sheridan, he's the tech analyst at Goldman Sachs today on the question of a bubble. We see some reasons to reference the late 90s, but don't yet see all the alignment for a market dynamic that would result in a dramatic and negative re-rating. Yeah. That seems to be the prevailing view. What about you?
That's right, Scott. I think the key word in there is yet. So we have to think about the capex announcements that we're getting in terms of the demand growth that we're expecting. And if we look at data centers, for example, today there's something like 82 gigawatts of data center capacity demand, and that's projected to go to 119 over the next several years. So all the announcements that you're getting are in order for us to get to that build out of data centers. But at some point, we will have built enough data center capacity, and the question is going to be, is the demand is actually there? So to me, one of the key points as we go through this earnings season is I think what investors are going to start questioning again, Scott, which is are there signs of AI monetization? Do we actually have companies that have killer apps that are generating revenues from those? Do we have tangible savings from infusing AI into companies? And, you know, I think we are seeing some of those signs for some of our portfolio companies, and we certainly focused on that. But I think the market will focus on the larger ecosystem. And I don't know if there are that many signs yet to point out to the monetization. So I do wonder if investors will start to question the trajectory of the AI capex trend near term.
Not until, you know, somebody warns about it or raises some flags about it, you know, in earnings or otherwise. Greg Brockman, OpenAI, he told Carl and Jim earlier, quote, "We need as much computing power as we can get." Lisa Su of AMD, AI compute is needed everywhere. So everybody's talking the same game, that there's just not enough compute. You're not going to need less, you're going to need more, and you have to spend. You'd rather err on the side of spending too much than too little, because that's the environment that you're in. There is these, you know, so-called circular deals, vendor financed deals, so to speak, that makes people a little bit nervous. But like I said, companies are making it awfully clear. They're saying it publicly, and I'm sure privately, they're just going to spend, and they're going to err on that side for now.
Scott, we're relying a lot on OpenAI, aren't we, in that spending? And we're relying on OpenAI to spend trillions of dollars, and I think the question becomes, where's this capital coming from? You can make the argument it's coming from venture capital, debt markets, some unique type of financing.
Yeah, they keep raising money. They're at a $500 billion valuation in the private market.
And I've said I think they're headed towards $1 trillion when they ultimately IPO. But this spending that we seem reliant on from OpenAI, obviously it benefits NVIDIA. You asked at the top of the show, what does the deal with AMD mean? Not very much. NVIDIA is down 40 basis points on the day.
It's barely down.